Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 29th of May, 2019, and we are discussing why gold to silver ratio of almost 90 to 1 is not madness, as some suggest, and may actually go even higher. Listeners to our channel are aware that we are bullish silver long term. Most are also aware that we are quite bearish of this precious metal short term. And so far, our predictions are being proved correct. We have produced many videos and podcasts on the subject of the gold to silver ratio over the years, and have frequently commented upon it in our weekly updates. We had to smile a little when we saw over the past few days some videos appearing stating that an 89 to 1 or 90 to 1 gold to silver ratio is madness and that it is not sustainable. In fact, some claim that it defies the law of nature because silver does not come out of the ground at a ratio of 90 to 1 compared with gold. This is true. It does not. The ratio has vacillated over the years, varying considerably decade to decade. Steve Santangelo, quite a popular precious metal analyst, commentator, who is very bullish gold and silver, published an article in Money Metals News on August the 21st, 2017, where he quoted, "According to the best sources, there have been approximately 173,000 metric tons, or 5.5 billion ounces, of gold produced since 1493, and 48.5 billion ounces of silver. This turns out to be a 9 to 1 ratio, which is the same as the ratio of silver to gold in the ground." Unquote. If we take the latest mining figures from the Silver Institute and the World Gold Council for last year, 2018, we discover that approximately 3,347 tons of gold were mined versus approximately 26,600 tons of silver, a mining gold to silver ratio of just under 8. So, it is true. It is nowhere near the ratio of 90 to 1. But please quote us the economic theory or law that states silver and gold has to be priced consequentially and in unison with the same rate that it is mined. If these items were perfect substitutes one for another, we may be having a different argument. However, they are not. The majority of silver is used for industrial purposes. Almost 60% of its demand is from industry, though it did fall slightly in 2018. Industrial demand for gold is minuscule by comparison. In general, central banks and governments see gold primarily as a monetary metal. Very few, if any, central banks and governments hold silver for such purposes. Now, for those who claim the ratio has to correct and soon, sorry, you are wrong. It may, but it doesn't have to. Clearly, these people are unaware that it was only some 28 years ago that the gold to silver ratio actually breached 100 to 1. It happened on the 1st of February 1991. Look it up. It is also interesting to note the trend at the low end of the gold to silver ratio. In 1970, some 50 years ago almost, the low was 15.39 to 1. 40 years ago, the low was 17.93 to 1. 30 years ago, the low was 37.88 to 1. The lows then hovered in the 30s 20 and 10 years ago. 5 years ago, the low was 62.15 to 1. 3 years ago, the low was 65.50 to 1. 1 year ago, the low was 75.54 to 1. And today, the gold to silver ratio stands at 89 to 1. One can see the increasing lows since 1970, and therefore one has to ask that if the trend for the gold to silver ratio is rising generally over a near 50-year period, or at least the lows are rising, why should it all of a sudden turn around now? And especially when central banks are purchasing more gold than they have for many years, and world economies are forecasting sluggish growth ahead, which undoubtedly will affect the demand for silver for industrial purposes. Ponder that question and those comments for just a moment. Now, we would also like to quote a most interesting commentary by John Barker, an investment executive at Sprott Global Resource Investments Limited, entitled No Silver Lining, published on the 1st of November 2018 on his LinkedIn page. We shall have to quote him in full so that we are not accused of cherry-picking, so please bear with us. And he does point out that his theory could prove wrong, but just listen to it for a moment. Quote, investors should be aware of the possibility they are wrong. Prepare for that scenario and not rely on predictions, nor always follow their crowd. Gold may be viewed as long-term intergenerational wealth, not silver, which I believe will approach the price of specialty salts or zero, for the sake of being dramatic. Below are two key aspects as to why this scenario might play out, and a possible solution is offered. 1. The gold to silver ratio is at all-time highs. Possible interpretation: weight to value ratio is horrible. Gold rose to be the dominant money by a spontaneous order, not a planned, forced order. The key characteristic is its high value to weight. There is a tremendous amount of wealth in the world, and a store of value must have a high weight to value ratio in order to be efficacious. Silver is extremely annoying to store. Central banks would have to store 75 to 80 tons of the stuff for each ton of gold. Even retail buyers of $10,000 worth of silver are annoyed. They feel like Pablo Escobar putting $100 bills in the walls. There is only so much silver I want to hide around the house or store in multiple safes. Technology has also made this irrelevant. You can now buy gold by the gram with online accounts. Mints also offer gold in 1 gram increments and thin credit card-sized bars you can easily divide. The doomsday message to own junk silver or quarter-ounce pieces is only to increase the money demand for silver, which is dying. If you need to make a quick escape, are you going to drag the silver around? Some quick math to deal with the ratio. If gold goes to $2,500 and silver ratio goes to 40 to 1, silver will be worth $63 an ounce. This is a 4 to 5-fold increase from today's price and sounds good. However, What is your average cost is the proper question. Silver is convenient to believe in and marketed for lottery-type gains. Fear and greed always work. The lack of money demand for silver is driving this ratio, and there is zero reason to suggest there should be reversion to the mean for the sake of returning to the mean. There needs to be a logical explanation for the ratio to return to the mean, not just what goes up must come down. 2. Industrial demand for silver is also at all-time highs. Possible interpretation: money demand is dead. This is the law of demand, specifically the change in quantity demanded in full effect. As the price of a good or service falls, more will be consumed, and more use is found. Just as quickly as silver had 1 million plus uses, it will have 1 million less uses as price rises, or the law of demand is not valid. Silver enthusiasts are suggesting there has been a change in demand, curve shift. This could be true. If it is, then money demand for silver is falling off a cliff. Partial evidence for this is the amount of novelty coins on offer, or selling quarter-ounce pieces of silver to buy breadcrumbs when fiat money dies. If industrial use was really driving the price of silver rather than holding it up, then the ratio would likely be closer to 8-1, better than the 16-1 when gold and silver was actual money. The law of demand and supply will be the final dagger in silver. I do believe silver will do fine in the next bull cycle for precious metals. There is sufficient demand, risk capital, on the sidelines to push it up. Although I would argue some percentage of this is in marijuana, stocks and cryptos. However, as the silver price goes up, the law of demand will kick in, and the industrial consumers will substitute out. The law of supply will also rear its ugly head, and supply will hit the market, and technology could find a permanent, cheaper replacement for silver, which will spell its doom. Asking why ad infinitum is useful and to be skeptical. I am open to alternative interpretations. One open question is how much silver investing is there in China and or India? I frequently hear these two markets are large consumers of gold. Why not silver if they are substantially poorer than Westerners? And silver traditionally played a role for smaller purchasers and is sometimes referred to as the poor man's silver. One way to own it is through leveraged physical, a contract for difference. You can obtain leverage bets from 500 to 1 and up. With this mechanism, you know to the penny your downside, and you may wager what you like for potential upside. The silver miners are another way to go, but then you have to deal with operational risk, political risk, geological risk, managerial risk, etc. A specially selected basket of silver miners should fare well in any silver price environment, not just silver $100. Prepare for the scenario of silver $15 forever, or only $50. The key message here is to step away from your crowd for a bit and ask why. I would consider not to own silver as a store of intergenerational wealth. Use gold. This is not a prediction, only a possible scenario to prepare for. Comments welcome, and please, anyone with info on India and China, please point me in the correct direction. Unquote. End of his article or commentary. Now, we're not going to pretend that we fully agree with all of these comments, but they are indeed worth thinking about. The key point he makes for us is when he states, quote, "There is zero reason to suggest there should be reversion to the mean for the sake of returning to the mean. There needs to be a logical explanation for the ratio to return to the mean, not just what goes up must come down," unquote. Here he is absolutely right in our view. If gold and silver were perfect substitutes for each other, and both purchased purely for monetary means, then we would be the first to say this gold to silver ratio must change, and soon. But they are not. Can we see a correction? Yes, in time. But we also believe it is indeed possible that the ratio can also rise to 100 to 1, as it did in 1991. 90 to 1 is on the cards, and soon. We predicted this months ago. It may take some digestion to see it go above 92 and 93 to 1, but we can indeed foresee that possibility too. Equally, to be fair, we can foresee it fall back to the mid-80s. We do, however, believe that a reversion to 50 to 1, let alone 16 to 1 or 8 to 1, will probably not be witnessed in our lifetime. What do you think? We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.